I'll tell you what, I think we got a lot to kind of kick into here because you're in the area that is damn sure the hot topic right now, you
It
know?
is. It
And you're
is.
getting to see it all from the inside, whether that's kind of the macroeconomic environment or the infrastructure, what's going on with fintechs,
Yeah.
connectors, the whole maze, man. So I want to get into all that, but I do want to give you just a couple of minutes, man. Give us a little intro and background. You've done a lot, man. You got a really cool history. So if you give us a little intro, that'd be awesome.
Yeah, sure. I think the three things that I usually say when people say, tell us a little bit about yourself. I am a technologist, so my background is doing software development and grew up doing software architecture, running software development groups. Been in this space for almost 3 decades, working on the vendor side, the fintech side, if you will. So we were building software and we were selling it to banks, all different kinds, banks that are community banks in a software as a service model, all the way up to BFA. So I live in Charlotte, North Carolina, and I got out of a college campus recruiting thing and then got a job here. And I've been working and living in Charlotte ever since, 3 decades here. So the company I worked for was building software. At that time, they were building software for Nations Bank and First Union and a couple of banks before they became Bank of America, before they became Wells Fargo. So technologies by trade, been in this space for 3 decades doing software for banks. And my last job was working in FIS. The company I was working with got acquired by FIS. So that's how I ended up in FIS running one of their software development groups.
Riaz,
Yep.
was that Zenmonics?
It was Broadway and Seymour was the company in Charlotte. So that company built branch software. We built sales and service in the branch, teller in the branch, call center software. And FIS acquired us because FIS had all these core banking systems and they were looking for a nice set of banking software. So that's how I ended up in FIS. So that company got acquired by one or two companies before FIS eventually acquired them. But the company's original roots were Broadway and Seymour. That's where Jack Prim and some of the guys from Jack Henry came from too.
Yeah,
So
right, right. Yeah.
yeah, there's a lot of history there.
Well,
I,
that the gray hair, you kind of fooled me.
yeah, so I left FIS in 2008 and started a company called Zenmonics. Since we didn't have any prior industry experience from a capital raise perspective, we bootstrapped the company and built the company by consulting for 4 or 5 years, and that's how we raised the capital. And I was always a product guy. I always wanted to build products and sold products. So we started building a product called Channel United. So instead of having individual pieces of software that run in each channel, they're all doing the same thing. They're all opening accounts and moving money and maintaining accounts. So why have a different software for call center, different software for branch, different software for online, if they're all doing the same functionality? So we built a single technology solution that had 200 banking components, account opening, account maintenance, money movement, and all of those pieces and parts. And we were able to deploy that in online banking, in teller, in sales and service. We call it Channel United, single technology stack that ran across multiple channels. So we partnered with FIS and sold it to a whole bunch of banks. And that's the company Zenmonics, right? And FIS acquired us in year 2020. So that's how I ended up going back to FIS, stayed there for a year, left FIS and started Infinant. And I believe Infinant is a logical extension of what we were doing in Zenmonics. So in Zenmonics, we were building all these APIs and feeding it to banking channels, whether it's online banking, mobile banking, sales and service in the branch, teller. Infinite is a little variation of it. We take all of that banking functions and instead of feeding to banking channels, now we are doing it to non-banking channels, call it embedded finance or banking as a service.
Right.
So that's my at a very high level. I'd say I'm a three things: technologist, been in this space for 3 decades, and the third one is I built a company and sold it. So this is my second rodeo.
All
Awesome.
right. Your second
Love
rodeo.
it.
That's great. All
I
right.
love it. I want to hit real quick. So I think what I really heard there was branch transformation,
Hmm.
and then let's call it digital, right?
Uh-huh.
Transformation. And now into let's push those things down to the brand and or the user level, right? So it's a really interesting progression because not to discount it, it's actually a hell of a compliment, but what you're talking about is the same effort through three different,
It is.
decades. really to three different constituent groups.
Banking is banking. Banking hasn't changed, right? So your account structures and your accounts haven't changed.
We can't say that.
We're still dealing with deposit accounts. We're still dealing with lending. We're still dealing with mortgages. The fundamentals of banking have not changed, right? You're still originating accounts. You're still moving money. Granted, you're moving money differently now. You're doing ACH wires, and now you're doing with real-time payments. And you're maintaining accounts, so that hasn't changed. What has changed is the way you do technology. The technology has changed, right? So in the past, we were doing all in the branch. People had to walk in and do banking. Then came in online. People were scared to do online transactions and online banking before. Then online became popular. When mobile became popular. All of this is still controlled by the bank, right? So it's banking channels, whether it's branch, call center, online, mobile, it's still controlled by the bank. What we are seeing now, the change is the more digitalization, it takes away the advantage of community banks. You're no longer having a lot of customers walk into your branches and where you can do upsell, cross-sell, and do personalized services. That still exists, but you are tapped out on growth. You cannot grow by just your branches. You got to look at other avenues. And the other avenue was digitalization and having a digital brand out there and being able to launch digital products, whether it is high yield CDs or high yield savings. But what we are seeing now is the reason why embedded finance really took off is a way for banks to expand its customer base, your deposit base, beyond your traditional banking channels. So banking is still core banking is the same. The way the products have been distributed has been changed. It's through the branches, through online, now through a non-banking channel.
Which opens up the whole issue of geography being the barrier that it once was, or the advantage. I remember even back when I was in college, the bigger banks had an advantage because if you lived in Houston and you went to college in Austin, it's like, well, there's probably a branch there. And so that allowed people to kind of get that leg up. And now I don't know that advantage really exists anymore. But the banks, if they're smart and savvy of how to use this non-geographical digital channel, and that's really where I think we're at in the beginnings of all this. I always tell people, I don't think we're at the end of the game. I think we're in the beginning.
Yeah, the beginning of the game. I totally agree with you. I think it's the communities where community banks, the geographic footprint was a big differentiator for community banks because people could walk into the branches and they could offer hyper personalized services because they knew the people in their community. And that was the biggest advantage they had. But now if you're doing digital, it's the playing field has been leveled. Now folks can do the same digital stuff with JP Morgan Chase. We can also do it with a community bank. So I say digitalization has changed the game, and community banks have to look at distributing their products and services differently and not just rely on having the branch in the neighborhood as the big differentiator.
Well, Tanner, you might want to address this, but also, instead of feeding up the food chain, it's now you can write to me, right? And go this way. So you've got this really cool opportunity that, let's just say that I'm going to make dumb examples here, but buy now, pay later, or get your payday check 2 days earlier, or earned wage like an Uber or whatever. These new products that, unless it's offered by the vendor of the bank, they really have a hard time keeping up or being able to offer those types of services on their own. Yeah. And I think what you've really built here is a different type of model. And we are all over the BHB Bass Association. We are bass people. We believe in it. I don't believe and never have believed in connectors. I think it's a disaster.
Yeah.
Because the bank has to own that damn ledger. They can talk all they want about how well that ledger is being monitored and how well we've done reconciliation. But in the end, as we've seen over and over now, we pounded the table on this one. There is the FinTech is not FDIC insured. The bank is. We all know that now.
Yep.
That everybody's figured. Let me say it another way. We knew that a long time ago. We've been trying to say that for a very long time. This ownership of the ledger, it removes the idea if the FinTech was to go out of business for whatever reason, lightning strike. It's not always bad and phony and bad. Things just happen. So whenever that event comes along, instead of the customers being part of a, let's just say, an order of accreditation, a creditor and a bankruptcy, unwinding, and that takes time. Those things are not like close on Friday, we got your money Monday morning. No, it's going to be like 60 days at best,
Yep.
right? And so that is crippling for people that have relied on that particular fintech as a banking instrument. And I don't think the public has caught up with that very well. There are ways to do this where you can go direct. I mean, you can set up 1 million accounts on the core if you want. It's kind of expensive. But there are other ways that you really kind of open that door. Now, let me just, can we put you on the spot?
Yep.
Give you a hard question?
Yep.
What you guys have done, and I want you to tell me, no, Dave, that's wrong.
Yep.
You've tacked on a layer to the core.
Yep.
That allows an interface between that world and the core banking world without having to rely on the core as a deliverer of products.
That's right.
Is that fair? But
That's
you're not
fair.
working like a connector. Is that correct? Or where
Exactly. We are not an intermediary. We're not an intermediary between the bank and the fintech, right? That's the model that was high risk because they were taking on program management and the risk and compliance and everything else. And the intermediary model is the one that's in trouble. So if you look at the couple of those intermediaries, they are saying, well, we don't want to be the intermediary anymore. We want to sell technology to the banks. Our starting position was that a year and a half ago, I was speaking in one of the conferences in Miami, and one of the bank asked us, why would we want to do risk and compliance and take on all of that stuff while we are signing up with an intermediary that is doing all of that stuff? I guess they will not ask me that question now with everything else that's going on in the market.
That's a damn truth.
Because you're a bank and that's what you need to do.
That question. I love it.
So we are not an intermediary.
That's the value of the charter.
It's the value of the charter. That's what you are. You're a trusted entity, and that's what you're supposed to do is your risk and compliance and the program management. We are a tech provider. We'll give you the tools for doing everything that you would want to do, but in the end, it's your responsibility to do it. And the difference between us and all those providers was exactly that. We didn't start by being an intermediary and trying to pivot with the way the others are doing. We always started by saying, look, you're a bank, you're a regulated entity. You need to do program management, risk, and compliance. We will give you technology and tools for you to do that. But at the end, it's your responsibility to do it. And that's what I believe is where embedded finance will be. Banks will need to do that for growth. It's still one of the most viable options for banks to grow, but they have to do it in a very responsible way, which means they have to be accountable for risk and compliance. So I think, Tanner, Dave, you brought up the difference between doing everything on the host. Yes, it's expensive, it's slow, it's multi-year contracts and everything else. And no, you can't go all the way to the right and say, I'm just being an intermediary, I'm just going to outsource everything. The middle ground is bank has to own that stuff. We give you tech to own it. It attaches it to your core, so you don't have to have a sidecar core and a heavy thing to put on it. So you can create virtual accounts, you can create a ledger that you control, that's you're in charge of, and you get the freedom from your host system because you're not putting all the accounts on the host. Because even if you look at all this thing that is happening right now, there's a successful factor of why fintechs, these intermediaries became successful because they were faster, they were doing all of this stuff.
Easy
and
button.
Core banking guys were slow in doing it, and they were not able to keep up with the new business models that are coming in. I say there is a middle ground. The middle ground is you still take advantage of your core, keep the bank running on your core, do not change that, but also have what I call Banking Technology Plus, which is our interlace platform that we put in right next to your core, but it allows you to do all of the new business models, whether you want to be a direct embedded finance player, direct BaaS player, you want to be in embedded finance, you want to launch a new product and service on your digital website. All of these you can do without touching your core or putting any burden on your core. That's what we do.
Man, I want to tell you, me and Tanner both are so excited about all this. Guys, nobody's saying it's perfect, but what we are saying is we're moving in the right direction rapidly. We've seen, some of these things, it's really frustrating when you point out that this was never going to work. And then when it implodes, everybody goes, well, there went BaaS. That's a bad idea. I'm like, wait.
Really, yeah.
BaaS is embedded finance. It is direct bank. It is a whole lot of different things, but I can tell you one damn thing it better be is the bank has control. Of the subledger, right? And now think about in the, Tanner might want to go into this a bit, but in the payments world, Visa, MasterCard, debit, credit, whatever, you've got a subledger anyway.
Yes.
And so there really is a reconciliation process. And then you've got your principal bank and all these type of things that go on as well. This is not new. It's just being done differently. And,
So
and a lot of this, I think what you said was so good about the pricing.
I got to comment on that one because this whole thing about subledgering, reconciliation and stuff is not new. You have to have an understanding and appreciation of that. Core banking systems, majority of them are running in batch mode, which means all of them, all the transactions are running in memo post until the end of the day, and there is a hard post at the end of the day.
Right.
So all of these newer ledgers that are coming out are real time. So you have to understand the difference between your real-time ledgers and the batch ledgers and how to reconcile it. We've been talking to a couple of banks that have 100+ people in the back office trying to reconcile this in a manual fashion. You don't reconcile it in manual way. You automate it. So if you're working with a bank, we automate that stuff. We say, look, here's all the stuff that you have coming from your real-time systems. Here's how the batch systems work. You can have shadow accounts on your system so you can keep track of all of it intraday, and then you post it. So there's a very clear accountability and very clear visibility on transactions that happen in real time, how they get aggregated, how they get posted. So when regulators come and ask you, where is the money? You have a clear way of saying, here's where the total money is. Here's how it's distributed. You got to have full visibility into it. I think some of the stuff comes from working in this space for a long time. We build teller systems, and if you imagine working in teller systems, we have to balance it to a penny in every branch. We do settlement and you do reconciliation. At the end of the day, it has to balance to a penny. So we have the understanding and the know-how of how to do reconciliation in systems like teller. And when we come in and do this stuff, it's like, this is not rocket science. This is stuff that how banking systems work. You have to understand how real-time systems work, how batch systems work, and you got to automate the reconciliation and not have to do it manually because you'll introduce a lot of errors.
Well, otherwise you could go in, I could do a remote deposit capture on my phone and then run in the bank and cash a check.
Yes.
How do we get caught? Well, we got that real-time reconciliation.
So what you guys are talking about is brilliant, and especially in the fintech land. A lot of that world, you got a lot younger people that don't know the history book. To your point, everything is real time. They think that batch is old, slow, and crazy, and it's like, then you don't understand risk and fraud. There are some positives to this, right? There's some reasons that we do some of this, but what you're really talking about, guys, that I see just from hearing and learning all these stories when I was younger, the branch transformation or branch automation process of the 80s was the key innovation that we are still working on today, right?
Yes.
It's, to your point, Riaz, it's just a little bit of a different delivery model and a different step in the hierarchy of who we're delivering it to. But it is that same problem, right, of branch automation.
It is. I'm 100% aligned with it. And so when we come in from the background of doing banking, whether it's in the branch or call center, and dealing with core backend systems, whether it is the systematics, the big irons of the world, or IBSs of the world, or Silver Lakes of the world, you understand the difference between real-time systems and batch systems, and you figure out how to reconcile it and automate it, and you don't introduce any manual steps on it. And that's the only way you survive. And when we look at what's going on in the industry today, how can you not know what account has what money? How can you not know this? This to us seems like really jaw-dropping to us because we come in from building systems that balance to a penny.
Yep. I want to give you guys one of the
rookies, man.
You bet. So just a quick shift here. There's so much talk on, the death of BaaS and embedded finance, and it's laughable because to anybody that's living in it and working in it and knows everybody, we've absolutely accelerated in the last 6 or 12 months drastically, right? We're approaching now, almost approaching 20% of the commercial banks that are doing something in BaaS and embedded finance. Okay, there's your early adopter curve. That means if you're a bank and you have commercial clients and you are wishy-washy or anti-BaaS, you're already a laggard. We're just about, right? And I think what has thrown everybody, and Riaz, tell me I'm crazy, it's okay, I know. There's a chunk of this world, the constituents that we might be delivering to that, or what FinTech was 10 years ago. That's your direct to consumer, Challenger, your Chimes, your Robinhoods, Rocket Mortgage, et cetera. Then there's this other group that is very interesting. It's what a lot of us kind of started calling the brands, aka commercial clients. That's your Home Depot, your, grocery stores,
Starbucks.
Napa Auto Parts, right? And even things like Uber get interesting.
Yep.
And I think that world is white hot. It's alive and well. I mean, just screaming. And that is, if you're a community banker, these are your either small businesses or commercial clients that require this new level of service.
I'm 100% aligned with you, 100%. So my saying is every bank should look at embedded finance. Direct BaaS is not for every bank, but embedded finance, every bank should look into it, because you have your commercial customers, small business customers, and you need to offer them more products and services. So I say every bank should look into embedded finance. Direct BaaS is a different thing. It's not for every bank, but for embedded finance, every bank should look into it, because you're offering existing products. And
Tanner said this a bunch of times, that if you talk about, what are the banks going to look like that do embedded finance versus those that won't? And he'll just tell you straight up, you're going to do embedded finance, or it's going to be like bank. There's nobody there anymore.
Exactly.
You're all going to do this, or you're not going to be able to serve your commercial customers.
If you look at the data, watching the shift, those 20% or close to 20% that are playing are absolutely taking businesses and commercial accounts from the 80% who are not. The work's already started.
Yep, I'm 100% aligned. I mean, that's my view on it as well. And when we see all this noise and everything else, I keep telling our guys, there's a lot of this stuff that will settle down, and you have to take the noise away from the reality of it. As the second wave of this embedded finance comes to fruition, we want to be one of the front runners in it, because we want to see banks succeed, and embedded finance still is going to be one of the only avenues for these banks to grow.
100%.
And it is banking as a service. That's what embedded finance is.
Yes.
I want everybody pound the table here. There's so many people, when something like this gets, let's say to the tip of the talking points with everyone, boy, the experts come out of the woodwork, and tongue in cheek there. But this idea of a new way to do banking and extend these services, I think what everybody kind of misses is it's a new way for, and I don't even like the word commercial clients. Hey, they're businesses. We like to compete when we're in business, right? And now you've given me another way to compete. I can compete in different areas financially, as opposed to just my product.
Yep.
It's a big difference.
Hey, I got a great question. This is going to be like, here's your predict the future part. So so here's the part where you put the feather on your head and okay, we're ready to go. All right. For, let's say, the connector model BaaS structure there, do you believe the bankers that embrace the new or better way to do BaaS banking and embedded finance, like what you're talking about, will assimilate those others and it will come back into banking? Or do you think the Wild West FinTech days are just going to get wilder?
I think banks are the central piece in the whole financial economy in the United States and the world. Banks are going to be the central key. So if anyone is talking about embedded finance, banking as a service, it has to be bank-centric and driven by the bank, and there is no ifs and buts around it. So what we will see is banks that are equipped with technology that will be able to do this with following the guidelines and regulations and compliance are the ones that are going to be winners in the future. So let me say this one more time. All the fintechs brands are looking for banks that understand how to do this right from a regulatory compliance perspective. And once your regulatory compliance is done, it's the most important thing. Technology will be the differentiator for these banks going in the future. So it's a combination of being regulatory compliant and a bank that is armed with good, solid technology. Those are the ones that are going to be winners. And to answer your question, Dave, It is going to be bank-centric. It's not going to be the Wild West. It is going to come back to be bank-driven stuff. That's my prediction.
I'm glad to hear that. I share that sentiment, and I know Tanner does too. There's an interesting moment in time right now. And I mean, people argue this to death, but I don't think mathematically there's any other way for this to work. And I think it is the greatest opportunity. And I've been saying it for a long time. Because we went a weird direction doesn't mean that was ever right.
Yeah, exactly.
Keep in mind, man, I've been really almost being preachy the last 5 years or so about small business. Small business is what community banking does.
Yes.
And I think we need to think a little more risky about that, right? That is, look, when you have a large market share in any environment, you need to be watching the back door, right? Mm-hmm. You got a lot to be taken away. It's not opportunity, it's risk, right? And so I think the fintech realm that really focused, like the Chimes of the world, on ripping apart the consumer, right? The end user, are now tackling the small business side of the world really well, right? The Squares, et cetera, right? And there's a lot going out the back door there. To the point, though, what can we really deliver from a charter that those businesses need, that is not just a differentiator, but a strategic advantage that nobody else without a charter could deliver?
That's right.
This is how you secure your business relationships. If you don't, they're unsecure. You're going to lose these guys. I don't know if it's next year, next week, or 50 years from now, but you can't if you don't extend that value of a charter to your businesses.
Can I get you another question?
Yeah.
You ready for another hard question?
Uh-huh.
Right. All right. If we were to look at this and say, this is, see if I can figure out how to get these words out of my head.
I love it.
When people sit down and say, look at ABC guy or ABC institution, they're leaders in this industry. For the love of Christ, can we all just realize it doesn't mean he's right? Okay. Yeah. A first adopter might get popularity, might have early success. And, that's where people get this idea about run fast and smash things. This is banking. We don't run fast and smash things. We might run fast and smash things, but I'd like to be the guy in second place.
That's right.
Am I on the right path here, that the people that were, let's just say, thought leaders or leadership, early adopting leadership into BaaS, that we all aspire or hail to as the best practice and Mr. Know-it-all kind of guy, maybe isn't the person to listen to? Maybe it's the second layer of people that come along, especially people that are repeat offenders in this space.
I say this is let's go take a step back. The primary reason why this embedded finance was done the way it was done is the banks want to grow, right? They want to get deposits, they want to get fee income. So the growth is the objective, right? Embedded finance seemed like a good way for these banks to grow. Since the core banking providers did not give them technology to be able to do that, to be able to provide API layers, to be able to provide sandboxes, to be able to do multi-tenancy on this, that gave an opportunity for BaaS middleware providers to come into the market and say, we will fill that vacuum, right?
Completely agree.
So the necessity was technology that these banks needed to be able to do embedded finance. The core banking providers didn't provide it. So there was a vacuum, and the BaaS middleware providers came in and filled the vacuum. So what was done was all the stuff that we hear now is banks did not do program management. They gave it to someone else. The objectives of those fintechs being driven by venture capitalists was growth, while the bank's objective and the bank stuff is it's a charter, it's trusted, it needs to do regulatory compliance and everything else. So there was a mismatch of the objectives of the bank versus the objective of the fintechs, and you see all the problems that happen. So I'm 100% aligned with you when I say the whole reason happened because there was a need that banks needed to grow, and there was a vacuum that the BaaS middleware providers filled it. But that doesn't necessarily mean that's the right thing to do. Just like how you see curves that come in and go, the first wave of embedded finance is coming to an end. We are seeing all of those things that are lessons learned, if you will. But nobody's questioning the need for these banks to grow, and nobody's questioning saying that embedded finance is bad. Everybody is saying the way it was done had challenges. And as we go through the next wave of embedded finance, what we will see is lessons learned and how things would change and adapt. And to your point, the first movers are not always necessarily right. They were filling a vacuum and filling it in the best way possible. But then you will see all the challenges that come out of it. The second wave that comes out will be lessons learned, will be taken into consideration. And you will see vendors like us, providers like us, who are building solutions, looking at what the first wave has done and learning from that and building solutions that would work in the second wave.
Can I give you a great compliment? And Tanner, I really wanted to hear your thoughts on this. Man, what he just said was great. He didn't say me. Look at me. He said the next wave will be people like us. He didn't say my company. And I believe in that. And I think that's right. And it's almost exactly the same point we were talking about. Don't put the wrong people on a pedestal. And likewise, I can't even tell you how many legacy associations and big names in the business and all the podcasts in the world, just absolutely stupid shit that have led so many bankers right off the cliff.
So real quick,
really frustrating when you watch this stuff. But for him to take the perspective, I'll go out on a limb and say companies like his are the tip of the spear of what will be successful. I'm not saying it's them. You say
it. The thing that is really, really frustrating to watch is this echo chamber of our industry. It's like nobody has ever publicly addressed a topic, and then somebody does. And I mean, out of the woodwork, everybody's talking about it and agreeing with different versions of that same reality. Nobody is an expert at all. This is actually like child's play to watch, right? If everybody wants to know, like, let me rip the Band-Aid off. Last week it was, is the FBO structure a problem? Of freaking course it is. We had that conversation 6 freaking years ago. I remember the room when we talked about it. But nobody has yet told everyone, do you know how we freaking got here? Because the core pricing model, I cannot go out and put a 15-year-old teenager with a savings account on my core at $8 per month for the cost of that SIF record.
You got it.
So I bundle them all into a single FBO. So core pricing basically created the problem that created the connector model that created freaking Synapse and Synctera and all the rest of them.
I think that's the thing that people are missing.
Nobody knows that.
Yeah, everybody talks about this stuff. This is very frustrating for me too. It's like FBO accounts are bad. We need to do this. We need to do that. Well, sit back and think about why FBO accounts were necessary in the first place, because you don't want to put all the accounts on the core. And now you got to create a subledger, which is cheaper, runs in the cloud, does all of those things that you would need, and the core can't do it. So you start doing it. If you put accounts on this subledgering, you got to do it. You got to reconcile to an account that sits on the core, because these subledgers are not certified for being compliant by all the regulations that the banking industry, the cores have done it for the last 40 years. So if you sit back and really think about it, then I can have a meaningful conversation. Not just saying FBO accounts are bad, or this is bad, or that's bad. There is a reason why everything was done the way it's done. You learn from that, you understand that stuff, and you fix those things that are due. For example, there's a lot of challenges with reconciliation. Of course, if you don't understand the difference between real-time systems and batch systems, you will have a lot of challenges if you don't automate it. Or we have problems with FBO accounts. Yes, if you have subledgering and if you know exactly where the money is, you have no issues with telling what this big FBO account translates to on the source. Each one of them has solutions. And if you're building systems for the last 30 years and you come into this space, you look like and say, all of these have solutions. It's not the end of the world the way everybody is talking and saying, oh, BaaS is bad, embedded finance is bad. That's what I was saying.
The last 2 minutes, guys, is why we did this, why we do this show. Go ahead.
You nailed something a minute ago, and I want everybody to really swallow this. You went right to, I mean, this is the brilliance of what you do. Hats off to you. You went right to branch automation. In the old days, guys, we've got, let's say, the holding company, not just the bank, the branches. There's a whole reconciliation process of deposits that could be from correspondent or actually one of the branches of ourselves, not to mention the transactionals of the day. It wasn't just summing our way to the top. So this process that I had to go through to balance the ledger every single day. Guys, people used to hop on airplanes and haul ass to Dallas to hit the Fed Reserve, right? There was a whole process that had to be automated. People like Tom Shin built that. All right. I don't think you're going to have a conversation with him when he's going to go, reconciliation. I don't get it. He gets it. Okay. But for you, Tanner, to be, and I don't want to say a younger guy, of course, you look like Riaz, man. He ain't got a gray hair in his head. You look good. But to understand that fundamental piece, what I'm saying out loud here is we've done this before if you get a banker and you really understand banking. The new kid on the block didn't get it. He missed a whole lot of regulations, a whole lot of cool things that could have been
That's what I was getting at. Really important is the last few minutes here that we've talked is the reason I do this show is to catch those little clips of this is what a real innovator, expert, badass behind the scene conversation really looks like. And the one that everybody's having online that you're watching is bogus. This is BS. These are rookies. This is it. And I think Riaz, I mean,
and personal brand building.
Short order there, we got
brand building, right? I'm building my brand today.
So, kind of a cautionary tale, right? Of there are some rock stars with lots of experience that built this world. Listen to those people, not the people who talk about those people.
Right. When he's saying,
I want to give you
I got 30 years experience in this. I hope the hell that isn't like, oh, wait a minute. He's too old to work in FinTech. No, he's
maybe
exactly what we need. Now,
just ready to
I'm
get
questioning
started.
the gray hair thing. I don't get that part, but I'm kidding. But I mean, 30 years experience, understanding this is what we need in the room right now.
Hey, we got a ball if you can't tell. You got us fired up today, man. This was awesome. But I want to give you a couple minutes. Final thoughts, anything you want to talk about, take it away.
I think my final thoughts are community banks need to grow. And we look at what we do with Interlace, our platform, our company is helping banks to grow in a very responsible way. And in spite of all the noise and everything else that's going on, we still feel embedded finance and everything associated with it has room in the future. And we believe there is a responsible way for doing it. And all the past 30 years, we've been helping banks do responsible banking through technology that we provide. And we hope that we have an opportunity to help banks do that in the next wave of whatever this thing is, embedded finance banking as a service.
How does he do that? He's so kind and he's so nice about it. And we're on the other side. Oh, you get upset about it. I get that way. I get pissed off, man. I mean, it's like I'm trying to help these guys. I'm not mad at the bankers. I'm mad at the solutions they've been given. And then he comes in here with all this knowledge and experience, and he's not pissed off about it at all. He's calm, relaxed, happy to be here.
Gotta have an entrepreneur, man.
Appreciate the opportunity to be here. Really do.
Hey, man, thank you so much for the great conversation. I know we'll keep in touch and keep going forward.
Sounds good.
You hang in there with me 1 minute. You hang in there with me 1 minute.
Uh-oh.
Something I want to embarrass Tanner now.
Oh, shit.
All right. This is the original FinTech Cowboy right there. You didn't know I had that, did you? Isn't that great?
Is that him?
Yeah, it's me.
That's Tanner.
Awesome. Thanks, man.
I appreciate it.
For the beard, though.
Yep. Next time.
Buddy.
Have a wonderful
I'll see you
afternoon.
later.
Come see us, man. Take care.
Alrighty.